Good afternoon. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital, and I am honored to be joined by my longtime industry friend and colleague, Mark Decker. Some of you may remember Mark as the former CEO of Centerspace, a Minneapolis-based residential REIT, apartment REIT. And Mark joined Global Medical several months ago. I was looking back at our conversation. We last spoke in August, and a lot has changed, obviously, since August to today for this conversation. I'm going to go through a couple of slides on our presentation. I'm going to take the presentation off, and then Mark and I are going to go back and forth on a little Q&A. For those that are attending today, if you have any questions, please feel free to put them in the chat. We'll get to them at the end of the presentation. If you are watching this afterwards on a replay and you have questions for Mark or the Global Medical Management team, send them along to us and we'll make sure your questions get answered as well. So with that, let's jump into the presentation real quick. Global Medical's primary mission is growing through investment in healthcare REIT or healthcare real estate assets. They are a net lease medical real estate investment trust. We'll go through their portfolio breakdown. They own about $1.5 billion in properties across 191 properties, totaling 5.2 million square feet of space, 315 tenants. They're over 95% occupied, 8.1% weighted average cap rate with a 5.3 average lease term. Note these are this presentation, a lot of the data comes from their most recent earnings press release supplement. The data is as of September 30th, since they just reported third quarter 25 earnings. A couple of quarterly highlights. They did sell 2 properties in the quarter, $3.8 million, a $300,000 gain. They did a 1-for-5 split back in September. We'll talk about that. And they did amend and restate their credit facility just a couple of weeks ago. This is the core bread and butter of Global Medical, their investment strategy, how they do their business, very disciplined in their market selection, their underwriting and due diligence process, trying to identify the best operators and owners with a long-term triple net lease structure in place. Looking at the tenant composition, now this did change just fractionally since their last presentation, but the healthcare system, for-profit, nonprofit, represents over 50% of their annual base rent, and almost 2/3 of it is in triple net. When you look at the various slices of the pie, about 3/4 in medical office, biggest exposures, Texas, hook 'em horns, Florida, Ohio, and then looking at, health systems, physician clinics, obviously, which makes sense with medical office properties, and then looking at the specialty types. An interesting topic is looking at the lease expiration schedule, something I'm sure Mark is spending a lot of time focusing on, as he's got about 22% million and change square feet coming up in the next year or two here, representing about 22% of their base rent. Looking at some of their key tenants here, this also changed just fractionally versus their last quarter update, but LifePoint, Encompass, Memorial, Trinity Health, Team Health, Tenant Health, and about 30%-ish of the tenant base. So with that, let's take the slides off, jump into some fun Q&A. And Mark, it's great to see you. Thanks so much for spending some time chatting with us today.
Yeah, thanks for having me. It's good to be here.
Let's just hit the first one right off the bat. Debt maturities. When people look at the debt situation with REITs, we get these headlines of this commercial real estate wall of debt that's coming due. And in your investor presentation, you do a really good job talking about both your debt ladder as well as how you hedge that. So for any investors that might be concerned about, let's say, upcoming debt maturities, what would you like to share with them?
Yeah, thanks. That's a good one. Well, yeah, I mean, when I got here, which was June, I walked into our CFO's office and said, hey, like, we have this twin tower maturity schedule. We had 55% of our debt coming in April of 26 and 45% coming in 28. And I said, I'd like to take it and make it a mobile home park. So, let's have 10 years of equal maturities in the best case. And we've gone a long way towards that. So we did refinance that 55% of our debt, and we were able to put 100 million of it into 29 and 100 into 30 and 150 into 31. And then we have the same 28 maturity of 150 million. So
here's that table for those that are interested. This does show some of the stuff that he's talking about right now.
Yeah. So if you were looking at a picture of this, it would look we're getting closer to. It looks at least like a neighborhood and not skyscrapers. So we're making real progress there. I think that the thing that you'll see us ideally do next is access the private placement market, which we've talked about that being a goal to do. The private placement market is kind of the baby investment grade market. So to do investment grade debt, you need a rating generally from S&P, Moody's, or Fitch, or ideally two of those. And you need to be able to do an index eligible deal of $350 million. We're too small for that. The market just beneath that is insurance companies, and there's probably 50, 60 insurance companies that will do unsecured corporate debt from durations of kind of 7 to 12 years. And so that's where we'd like to go. And that's an important part of getting that schedule. Bank capital generally doesn't really want to go out past 5 years. And currently all of our debt capital comes from banks. And we are 100% secured, which for a company of our size is pretty remarkable. But anyway, the point is, I guess, what would I want someone to hear? We've taken the maturities off the table, and I think we've done it quite well. So thanks to the team for that good work.
I like your analogy of a neighborhood versus a skyscraper. I haven't heard that one before. And then if a picture tells 1,000 words or 1,000 stories, I think that's a great analogy, trying to go towards a neighborhood maturity schedule versus a huge skyscraper coming up. That's a good one. So you did do some development earlier this year. What do you think it would take for the external acquisition engine to really start roaring again?
Yeah, we actually, the deal we did earlier this year was an acquisition, and we would consider development as a financier. I think when we think about development, at least the way I think about development, is you sort of have 4 risks: pursuit, construction, and environmental. And then what's the rent going to be, and what are the capital markets going to be? Those second 2 risks we already own in abundance and feel very qualified to take. The pursuit and the construction risks are ones we really don't want to take. So I could imagine partnering with developers who feel like they're good at that, and we would have to agree that they're good at that. And then they would get rewarded for that in the form of fees and possibly a promote. So that's probably how we would go at development. On the acquisition side, we have a great team. I mean, I really feel like the special sauce here is our ability to understand the real estate, understand the medical use, and make good decisions in terms of putting capital there. I mean, what we really need is a stock that works. And right now, we don't have that. I'd say the industry overall is kind of suffering from a funds flow malaise. And I would say we, being among the smallest companies in the space, probably feel that more than most. So we're just super cheap right now. We couldn't issue equity at prices and invest it creatively today.
We did briefly talk about the credit facility. I guess, what is the true impact, would you say, of the recast here? Does this help you potentially get over the hump with these ratings agencies? Do you think that this provides some tailwinds into 26, 27, and beyond? Like, again, for people that aren't really, let's say, all that educated about credit facilities and the impact, what would you share with us?
Yeah, I think it's huge in that it eliminates uncertainty, which is generally discounted in the world of finance. And so we've eliminated that uncertainty. Obviously, we had a bunch of banks support us and extend us $700 million of credit in the form of our line of credit and that recast of the term loan A. So, I mean, that is huge. I would say when I was talking to the board about joining, there were sort of 3 really big problems for the stock. One of them was we publicly announced that we were going to have a new CEO, so that's uncertainty. A second one was we were overpaying our dividend, and the third one was we had these debt maturities. So new CEO, at least you can make an opinion. If you don't like me, you probably don't like the stock. But if I'm not objectionable, then you could have other things you do like. One of them would be we cut the dividend to a level where we have retained cash flow, and the other one was we recast a line. So I think the fourth problem that you didn't ask about was, we haven't been growing our cash flow per share. We're in good company there. There's a lot of the other medical REITs really haven't been doing that either. That's a factor of the rate rollover that you talked about kind of at the top. And so I think we need to prove that we can do that. I feel really confident we can. And then I think we'll sort of have a good game. Steve Sakwa and Jim Cameron at ISI. They're some of the best in the business. And I was reading one of their reports on Friday. They do a funds flow report and kind of valuation book every week. And they talked about how the average REIT is trading around 20 times AFFO, adjusted funds from operations, which for the folks who aren't into acronyms is essentially RFFO, which is kind of REIT EPS equivalent minus CapEx and leasing commissions to get to kind of a cash flow number, true cash. The average REIT is trading around 20 times FFO, which is a premium to the historical average of around 17. We're trading at around 10, 11. So why? Well, I think we're viewed as below the average. We're below average size. We've got below average growth. We've got a below average balance sheet if you measure in terms of debt to EBITDA or leverage to total cap or leverage to book, whatever metric you want to pick. Now, they're not problematic levels. If you and I were just on this company ourselves, we'd be thrilled. But relative to peers, I think people would like to see us with a little bit less leverage on the books. And obviously, we'll go at that. The way at that is asset sales for the most part. But I think we just need to keep on knocking some of these things down. And I think I'm confident that we can be at least average.
So let's look at the other side of the equation on the equity side. You just did this one for 5 reverse split. Why? What are the implications and what does that mean?
Yeah, I got to tell you, so far that idea has aged pretty poorly. My desire to do it, and I'd say the board was supportive, but sort of like, I don't know, why are we doing this? Is that, at some point in the future, it could be soon, it could be a year from now, we're going to be sitting with a 72-year-old heart surgeon who doesn't want to pay taxes on a sale and is looking at an operating partnership unit type deal, which is a tool I used really effectively at Centerspace. And he's going to call his financial advisor and he's going to say, these guys have a $9 stock or $7 stock or single digit stock. No. I mean, there is a group of people who are, I'd say, my age and older who think of single dollar stock prices as just standalone bad. And it's an economic non-event, but it is an optic event. And as I learned, it is a trading event, which I probably wasn't as respectful of as I could have been. But I think in terms of putting ourselves in position to be a fit counterparty in the eyes of most, it's an important step. And, we are playing for long term on things like that.
So speaking of long term, I showed the slide of your geographic footprint mentioning Florida, Texas. How do you think that pie evolves, let's say, over the next 5 to 10 years? Do you see you growing in Texas? Are you suddenly going to wake up tomorrow and expand in Wisconsin? What's the thought outlook there?
Yeah, I mean, this is somewhat unusual, I guess, for a traditional real estate company, but we're less market focused and more customer and use focused. And so the answer is depends. I mean, we're looking at opportunities all over the place. We don't say we've got to have a pin in the map in Raleigh. The fact is, if you said that, the market can be pretty thin. This is a market that trades roughly, this will be a bumper year, 25 will, but generally speaking, for the last 10 years, it's like 10 to $12 billion of outpatient medical assets that trade, which is relatively small. That'd be like half a year of really good apartment volume in Dallas, to pick one of your faves. So if you think about that in national terms and you start breaking it up among markets, and you think about a market like Raleigh, just to stick with that example, they might trade $100 million of stuff in the next 18 months. And like, are we going to commit to buy all of it? Or a third of it, no, we won't do that. I mean, what we're going to be focused on is, do we like the provider and what they're doing there, and the census, the population of potential patients, and is it growing overall? So we really look at things kind of on a zip code basis, and what's the health of that zip code, what's happening in the building, and then we look at the physical real estate. So do we like the actual sticks and bricks, so to speak, and the basis and the rents? And you can get in trouble in every direction. You could have a great credit tenant in a banging location that you paid too much for, and you bought a stream of rents that are too high, and the use that they're doing there is administrative and they're going to cut it. You could have a no-name credit in a less dynamic location, but have below market rents and a basis you really like, and a use that if the name on the door changes, they're still going to do what they're doing there. So it really depends, and we're really focused on the business that's happening kind of in our four walls more than anything. And then, do we have the rents right? Do we have the basis right? That's everything.
What about the tenant? You have in a couple different places, you talk about a strong, diverse healthcare tenant base. How does that tenant base benefit the end investor?
Yeah, well, I mean, I think one of the things I really like about this stream of cash flows is it's super diverse. So more like apartments, where you have a lot, it's kind of no one can kill you. We're not quite as good as apartments. We have, as you put up earlier, kind of a handful of top tenants that make up the six, I think you showed, make up less than 30%. That's really pretty good. That's pretty diverse. I'd love for that to be more diverse. If you're just talking generally about cash flow streams, more diversity is good. That's the benefit to the investors. But again, that's a base level consideration. The next level is, at the building level, like I was just talking about, what happens there, and do we like the use, so to speak?
You briefly mentioned back in May, I guess you would use the term right-sized the dividend. You cut it from 21 to 15 cents. Obviously, when people think about REITs as dividend income machines, talk about current dividend coverage and safety, and let's say potential keys to regrow that dividend.
Yeah. So we were just overpaying the dividend. So we were borrowing to pay it, which isn't optimal. I'd say suboptimal, but it's something you could do for a very long time. I mean, we were overpaying, by my math, something like $2 million a quarter, which for an enterprise that has 117 million of NOI, you could do for a long time. But we had no free cash flow, so no ability to generate internal growth. And in fact, that 2 million a quarter adds up to 8 million a year. At 5% costs us 400 grand, which is a couple pennies. So it was dilutive. Now we're going to retain roughly 10 million-ish a year. And so look, that starts out small, but it can snowball, especially if we do good things with it. So at a minimum, we could reduce debt. In an ideal world, we can come up with ideas that are accretive to the overall quality of earnings. And that payout represents roughly 80% of cash flow after everything. So again, I'll use that AFFO number again. We actually currently report an AFFO number, which I would say is more like core FFO. But to stay out of the word salad, we're essentially paying out 80% of cash flow after capitals, debt, G&A, kind of everything. And that's a much better spot. And my goal would be to meaningfully grow that free cash flow and eventually the dividend. But, we're not getting credit for the dividend right now. It's trading like we can't afford it. We're currently sitting today at around $32 a share, paying $3 a share. That's over 9% dividend. And for those individuals out there, if you go back and look at our historical composition, we've been kind of 20 to 35% or more return of capital. So that's 9+% historically tax deferred some portion. I mean, that's pretty sweet. So you won't see us raise that for a while until people start caring about it. And the institutions, as you know, David, who comprise And we actually have a lot of individuals in our stock, so we care about them. And I can tell you, it was a hand-wringing decision for the board to cut that. It was absolutely the right thing to do. You shouldn't pay your bills out of savings if you don't have to. But on the institutional side, they would prefer to see us never raise the dividend. So, we're trying to thread the needle there and just do the right thing for the business, which we absolutely did with the cut.
Another 10,000-foot headline would be, let's say, tariffs. How do tariffs potentially impact you and or your tenants?
Yeah, they really don't. I mean, this is a domestic business. The biggest headline risk for us would be something in Medicare. I mean, it's really, our business is about the payer and not the supply chain. The payer in many instances is usually private insurance or Medicare. We don't have a ton of Medicaid. And for those of you who think that's word salad, Medicaid is, generally speaking, people with less means. Medicare is generally retired people. Private pay insurance is generally employed people who have healthcare insurance through their work. But we don't have a lot of what I would call pen risk, which is Medicare changes the payment on something. And in fact, thematically, what happens in our buildings is generally outpatient care, and outpatient is the preferred and least expensive modality for that care to be delivered. So if you were talking to a large, acute care health system, they are trying to push care into those outpatient facilities, and their customers would rather get their care there. So, people would rather get their knee scoped, 2 miles away from their house than drive, downtown or to some larger center to go to a general hospital.
You briefly touched on Medicare, Medicaid. If we talk about changes in reimbursements, if you had to guess, how much of your profitability would you say is exposed to a change in reimbursements or other Medicare, Medicaid policies?
Yeah, very few. Our biggest risk there would be we have a portfolio. It's about 17% of our NOI of inpatient rehab facilities. This is where you would want to go if you to spend 2 to 3 weeks to recover from some surgical event. Those businesses are generally very profitable, and that is a risk. The Medicare system says, hey, these reimbursements are unfair. But if you look at those businesses, they are profitable, healthy businesses, and they could probably withstand some cut. And I also would tell you, healthcare is measured certainly in cost, but it's also measured in outcomes, and they get really good outcomes in those facilities. So I'd say one of the good knocks you hear is, well, hey, you could do that at any skilled nursing facility, and that just isn't typically the case. So your outcomes are better, and that's worth more, and so they pay more. But that's the portfolio that I think has the biggest pen risk. The rest of it is, I think, much less susceptible.
What do you think the future of healthcare looks like? And let's call it the demand for convenience. Do you see any big changes there?
Well, that's a great question. I mean, I couldn't convince anyone who was a healthcare expert that I was one. So that's a hard question to answer credibly. But I would say, based on what I'm reading and the smart people I'm talking to, there's lots of technology and there's lots of hopeful abundance coming and productivity. And I think generally that means more time, and it means more focus on health. And I'd say generally that's a good thing for our customer base, the people who deliver healthcare. And you can see some pretty big effects. I mean, if you were a gastrointestinal clinic, the GLP-1s have pretty much killed your business. So, some of that's going to be disruptive, but it's also going to be good, for the general population. And, our job is to work with operators who are, we're not going to tell the operators what's happening in healthcare. We're going to learn from them and just try to be a good real estate partner. That's how we can best learn. But great question. I think obviously people want more convenience. They want it cheaper, and they want to live longer. And we'd love to be helpful in that process.
Let's do a bolt-on question. You mentioned disruptive technology. I'm going to throw your two favorite letters out at you. How about AI?
Uh, yeah, I mean, listen, great question. I think people are using it currently administratively and getting some productivity gains from what we hear. I would say we and others like us are. I think that's true on the healthcare side. I'm on the camp of people will do more. I mean, it'd be like going into college finance class and saying you can't use Excel anymore, use an abacus. Like, obviously, AI is more dynamic, or has the potential, I think, to be more dynamic than Excel. So I'm hopeful that that's how it shakes out, and I think it'll be choppy, perhaps in between. But in terms of what we know in terms of how care is delivered, I think a bigger theme for us today might be if you look at all the practices that got gobbled up by hospital groups in the last 10 years, which was really a big trend. I think a lot of those doctors groups, from what we hear, are less happy, and you might see that revert. To me, that's probably bigger than AI. But boy, I'd love to have AI somehow tagged into the REIT sector so we could catch some fund flows.
You're telling me. All hail our future robot overlords, as they say.
That's right.
But sure, the robot's going to do the surgery at the hospital or whatever it is, but somebody still has to control the robot, press the buttons to get the robot to do the thing. So, at an assisted living facility or something like that, some type of nursing home or something, there's still hands-on patient care. You're not, again, AI isn't going to replace hands-on patient care interaction, dealing with loved ones, et cetera. So, I feel like there's still always going to be some type of human component with this.
Yeah, I mean, listen, I think actually there's an element of robotics and AI that could be really positive when you think about elder care. I mean, imagine being able to have, like, let's imagine you were a fish nerd, and you were sitting
For the
there.
record, you brought it up, not me. Thank you.
Yeah, well, I just wanted to hit you that waist high fastball. But imagine, 30 years from now, you're eating all your food through a straw and no one wants to talk to you. And there's a robot there that can talk to you about every fish thing ever created and play the show you went to in Vermont, or, whatever. Like, that's pretty amazing. And if you look at the folks who are giving that care, the people are one of the most important resources, and they are generally stretched, and they're generally expensive, and they're generally shorthanded. So you could imagine if you had a robot that could talk to you all day about fish, and then someone else could go deliver the really important stuff, even though to you the fish thing is the important stuff. Like, that could be awesome. So I'm hopeful and believe that kind of thing it will happen. Now, will they also tell you what to do in every other aspect? I hope not, but we'll see.
You just gave me the chills. Thank you. All right. So, what keeps you up at night these days?
This getting the speed of our plan. I mean, this is a repositioning, and that's worth repeating. And I read our research notes, and I'm grateful people spend time to write research on us. But something like they reported this quarter, and it was like, yeah, they were off a penny. This happened. Like, guys, it's a reposition, and so I think about getting that done as quickly as possible. Getting a currency, REIT funds flows, and relative value, and how we sort of get our whole industry off the mat. I think it generally provides better outcomes than many of the alternatives that are winning right now. But and then we have a new puppy, and I have 3 teenagers, so and a 22-year-old. Those things keep me up probably more than anything else. But
none of your cars?
No. Those are there's just known constant problems. So
let's put a pretty bow on this, Mark. So, why Global Medical, and what's the value proposition next year and beyond?
Oh, yeah. Well, I think we're a good company at an outstanding price. We're working to make it a great company, but it's a huge space. We have excellent expertise. We have kind of the law of small work numbers kind of working for us. We have the chance to be pretty growthy, and you get the opportunity to be part of a wonderful business, and you can do it right now. I mean, if we did trade to, let's just say we traded to a 20% discount to Sacco and Camera, it's 17 times AFFO. That would be roughly 14, 15 times. That'd be a 30% premium from here, plus you get paid 9%. So if you can find lots of other 40% opportunities where not a lot of good things have to happen, please tell me more about them.
With that, we'll open it up to audience Q&A. And if there is no audience Q&A, I do look forward to reconnecting with you next quarter. We will do this exact same thing. We will see how this quarter evolves, both in terms of economic data, government shutdown, tariffs, all that fun stuff. Do we see some tailwinds come back? We did see that story from Blackstone published last week about disposing their senior housing portfolio, frankly, at a pretty big discount, at a loss compared to other folks. So there's a lot of good stories that are out there for us to follow. And Mark, on behalf of our audience and viewers that are coming up, stumbling upon this, we can't thank you enough for giving up some of your time to share your thoughts and outlook with us.
Yeah, it's my pleasure. Thanks so much, David.
Thanks, Mark.
Alrighty, be good.
Hang with me one sec.